Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Smaller companies join the party. Well, it's been a tug of war between the biggest of the big companies, sometimes referred to as the Magnificent Seven, which basically are the largest 7 companies that make up a big chunk of market indexes like the S&P 500. And, well, then there's the rest of the market. Now, after outperforming for the past couple of years, the largest companies took a bit of a breather in the first few months of this year before reasserting their dominance basically from mid-April through last week. This past week, however, smaller companies took the reins as the Russell 2000 index of small companies made its first new highs since January, up roughly 5%. That's versus the S&P 500 gain of about 1%. So is this another inflection point or just some portfolio rebalancing taking place after a big run in the large growth stocks? It's tough to say, but the market rotation looks healthy from the perspective of this bull market continuing for at least a while longer. It is a good lesson, however, in why you should stay diversified and resist the urge to put too many eggs in any one basket. For this week's featured insight, understanding rate cuts. I've talked a lot about the Federal Reserve monetary policy and interest rates on the Investor's Edge, but it's always important to reiterate some key concepts, especially for newer viewers. When you hear talk of the Fed cutting interest rates, what are they talking about? Well, they're talking about the Fed funds rate, which is the rate that banks lend to each other in the overnight market. So it's the shortest of short-term interest rates. And while all interest rates are at least somewhat interconnected, this does not mean that all interest rates will go down when the Fed cuts the Fed funds rate. In fact, the last time the Fed cut rates, longer-term interest rates actually rose, including mortgage rates. So it's certainly possible this could happen again if the market expects the Fed cutting rates pushes inflation expectations higher. Now, the rate most people are familiar with that will be very closely impacted by rate cuts is the money market interest rate. Expect the rate you earn on your money market savings account to move lower between now and the end of the year by roughly the same amount that the Fed cuts. Looking ahead, lots of data on housing. So the housing market's been a bit of a conundrum for a while now. Prices are too high because there's not enough supply. It's exacerbated by too high interest rates, so no one with a low mortgage rate wants to move, and so on and so on. Now, housing's also been a market where it doesn't seem like anyone's really happy with it. Doesn't matter if you're a buyer, a seller, or a builder, everybody seems frustrated. Well, we'll get a lot more insight into what's really going on with housing next week with some type of housing data being reported almost every day. We get the Home Builder Confidence Index on Monday, housing starts and building permits on Tuesday, and then existing home sales numbers on Thursday. So who knows, maybe there will be some signs that housing is turning the corner. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.